Let's welcome in our next guest, Kenneth Andrade, founder and CEO at Old Bridge Capital Management. Kenneth, it's really been a while and you've had a change of role as well. So can you just tell us about the new role? What does Old Bridge Capital Management do?
We've just got a license to start a portfolio management service in India. So this will be largely for domestic clients. I take on from my last assignments, which has been 15 years of fund management experience, and also 25 years of work ex in the entire capital markets. So looking forward to put up a small domestic product over the next couple of months, and looking to get back to investing all over again.
Right. So as of now, no investments. We are in the process of making investments.
Yeah, it's a relatively new organization, and we're looking to build it forward into the next couple of years, and starting 2016.
Right. So let's talk about markets and what is the feel that you get. So if I would have asked you in the month of Jan and Feb, you are one person who would look at the valuations, the growth going ahead, what is expected. You're very you're largely a very conservative investor. So at this level, say if one had to invest or buy into equities here into Indian markets, the returns would be very, very back-ended?
Well, a lot of stock prices are reflecting a reasonable amount of optimism, but I don't think that's an India problem really. It's something that's happening across the asset market across the world, and that's where the problem really arises. So locally, we definitely have our challenges, but in terms of balance sheet sizes, both with the government, corporate India, and consumers in India, I think it's much more manageable than what the rest of the world is. Second is, I think we've got our policies right in place right now, and a lot of inefficiencies are coming out of the system and will contribute to growth over the near term also. So I'm a little cautious on where valuations in the market stand at this point in time. But even in the medium term, I think we should be quite okay as equity investors in India.
Right. Say if we would look at the earnings so far that we've got, generally you would expect the companies that deliver earlier should deliver good growth. But IndusInd was just okay. Infosys, TCS, HUL was also not that great. Expectations from Wipro are particularly weak. So do you think the 15-16% number that the street is going in with for this year may see a revision after the Q1, which may not be liked by the markets?
I'm not too sure if the street is going in with 15 to 16% because that's the kind of growth you haven't seen for the last 4 or 5 years. So I don't think the ship can turn itself so soon and not such a large and with not such a large degree. I'd be more happy if earnings were moderated. Look, we've got a 3-year flat kind of a structure in terms of corporate earnings. And rather than just looking at one part of the entire equation, which is corporate earnings, I essentially look to see how well India is getting restructured on the balance sheet side of it all. And on the balance sheet side, I think this year, 2016-17, and a large part of 2016 also, you've seen companies not wanting to invest, wanting to generate cash flows and pay down significant amount of their liabilities that is there. So the incremental amount of investment that is coming is not showing up, will not show up on balance sheets going into even 2017 and 2018. And once you've got your costs and your balance sheets under control, I think then you're geared up for the next round of growth. So my sense is we're still in a consolidation phase. Your financial system is going through a large consolidation phase. Corporate India started its consolidation last year, or probably even 2015. Some of these companies started off with. So we've hit the bottom and we've actually bounced incrementally back. But I don't think we're some time away before we see mid-teen earnings again in corporate India.
Mr. Andrade, good morning. This is Anindya from the Delhi studio. I just want to rewind a little bit and I want to dip into 15 years of experience that you have as a fund manager. What we've seen in the last 2-3 years or even longer, let's say 5-year period, do you remember from your own fund managing experience a similar pattern that would have happened earlier?
Oh yeah, these things happen quite often. And what happened in the last 5 years is you got a brilliant valuation opportunity somewhere in 2013. So if you're an investor in 2013 or late 2012, 2013 and even 2014, your returns would be definitely double digit. Of course, it may not have come from the index category or the top 50 companies, because those are companies struggling with their own challenges. But if you had built a portfolio across the breadth of the market, or even if you look at some of the large portfolios that exist in the market, your returns have been double digit, or even closer to the high teen levels. So there's not been a challenge in terms of making returns on in India equities. The challenge remains is how can you turn this into a secular trend. So like I said, the corporate environment is bottomed out. It is very similar to what happened in year 2000 to maybe year 2002. The only difference this time is that probably the international economy or the international environment is far more volatile than the Indian environment.
That's what I wanted to ask you, because if I look at the last bottom that we saw, let's say 2000, probably around the time when you were starting as a fund manager, and since then there was a major US-led recovery post 2001, and it was driven by easy money, the entire Greenspan, Bernanke part that we saw. Significant armaments expenditure by the US government, which had multiplier effects across the world. And you saw a major boom in India, which some people say was an outcome of what the previous NDA government, the Vajpayee government, had done, and the UPA government took forward. But essentially it was the rise of finance, right? Because if you look at what led to the first round of growth from 2003 to 2008, we saw infrastructure driving it up. That seems to have disappeared now.
Well, there are many reasons why markets get created. Okay, and if you go back to 2008, which has been the latter part of your observation, it was the entire capex cycle across the world that drove it. If you go back to year 2000, it was a technology investment that actually drove it. This time around, we're still looking for anchors around what will drive the market, and that seems to be missing in the near term. But in the longer term, I think within the region you will find a reasonable amount of opportunity that comes with consumers and their ability to leverage and starting up a consumer cycle, whether it's in India or whether it's in some of our larger emerging markets around us. So we just have to give it some time. We will have to let this liquidity digest itself. Markets and economies always come back to mean. So even if we keep worrying about the international environment in terms of high liquidity and interest rates tightening up, I do not have a call on it, and I do not want to have a call on an event like this. But over a period of time, I think once you retrace that mean, India as an environment will be affected, but I think we'll be moderately affected by any volatility that's coming into financial assets worldwide.
Actually, so near term, I was trying to be a little more specific here, and let me just rephrase that question. I'm saying that if I take a look at India, and I don't know whether you can talk stocks given your compliance requirements, but if I look at the GVKs, the Lancos, the GMRs, all of which actually rose dramatically, driven by easy credit from the PSU banking sector and raising money from the markets as well. They got big contracts, which they ended up doing on very low equity base, right? Heavy debt, low equity. When you look at those balance sheets, then there are a lot of holes in. I'm not talking about these three companies, but there are many holes in various companies which came up at that time, got massive valuations. It was a growth driven by a credit bubble which has collapsed. Now, I understand you're saying that there are structural changes, and 2016-17 is going to be the cleaning up of that credit period. But 5 lakh crores still of stressed assets on a conservative basis in the power sector, out of which probably right now not even 1 lakh crore has been cleaned up. Do you really believe that it will just take 1 or 2 years for that to get okay?
Well, there has been no fresh lending to any of these projects since year 2012, or maybe even a little earlier than that. So what the system seems to be dealing with is all the assets that have been created before that. And while we have, and while we are looking at it from a extremely from a very recent event point of view, if I take you back to the 90s, you had very large steel companies that actually went under. Okay, and what led to the credit crisis with the same set of companies, which is public sector banks in that period, was industries like textiles, some part of sugar processing, and metals. All those companies put up massive capacity.
The only difference was that the government came in and nationalized those, took over that debt, kind of gave a bailout to all those companies, right? The entire textile sector gained from that.
No, nobody got nationalized.
No, a lot of the government bailed out the entire textile sector in the 80s. The long textile mills were allowed to sell their assets, were allowed to hold on to their assets. They really didn't have to do anything about it. I'm saying today the valuation of the assets itself is under question.
I think cycle is very much the same. I'm not too sure if the government stepped in the 90s to bail out most of those companies.
No, I'm talking about 80s.
But those companies went bankrupt and they did sell assets on the ground. I agree with that part. The NPA cycle in the turn of the century went almost to 12%. Okay, which is very similar to what the environment is like today. Of course, the size of the problem in terms of absolute value is larger, but in terms of context and percentages, they work out the same. And you've just gotten down to restructuring probably last year. This year, you've seen a number of companies put up their assets for sale. I'm sure you'll find a way to restructure a large part of these assets. And we will build the financial system all over again with completely new participants. I think it's an industry cycle you're going through. You got optimism that was built on top, and you got pessimism which is just
again. I just want to be to get your views because there are a lot of these the confusion. There's a lot of cross talk about it. Let me look at the assets which are getting restructured, sold. So you have cement, you have power, which is already operating. But a large part of the debt in power, for instance, is of capacities which have no power purchase agreements, have never produced a single unit of power till now. And there are SEBs which will never buy at the rate at which it becomes profitable. So if I have a JSW Energy buying a JP Ventures power company today, it has a plant load factor which is at least 65% currently. Right? It has a power purchase agreement with Madhya Pradesh. It does sell merchant power currently. So approximately 80% of what it produces is sold. If I look at the cement companies where we are seeing assets being sold, whether it's Holcim which sells for its international operations, these are productive capacities. That is my question again. Just for the viewers, if you could explain, how far is the existing assets, how far can they really be sold to restructure debt?
Okay. So let's quantify these numbers. Okay, 1 megawatt of power capacity takes about 6 crores to put up. Assuming that this is in some semi-finished state of construction, to make it operational, the number will go up to about 8 crores. Okay, on 8 crores, I'm not too sure if raw material is really a problem at this point in time. But assuming that you solve your raw material problems and start generating power, you will be able to earn a return on capital employed, which is closer to about 9 or 10%, say worst case. Okay, so if you earn a return on capital of between 9 and 10%, and your cost of debt is between 9 and 10%, you are servicing your debt obligation. The question here is, what is in it for the equity shareholder? Nothing. Okay, which is largely representative of the fact that equity as a percentage of the entire enterprise value of some of these names that you put out is virtually negligible. Yes, negligible. So what we need to also put into context here is that the asset which is on the ground is not equivalent to a pricing of zero, even if it is non-operational. There is a salvage value for it, and if you complete the power plant or the operational asset even at a higher cost, okay, you will earn a lower cost return on your capital employed. Okay, And the first hit that any fund any financer would have to take will be the equity guys before it goes on to the fixed income or the banking sector. And even if the banking sector does have to take a haircut, you will have to take a haircut of probably 10%, 20% of the entire project cost and make it viable. So I'm just coming from the context that you haven't seen a new problem that has been funded after 2012, which is surfacing now.
My question then, my next question to you
would be... It's not such a big deal.
Sorry, completely. Sorry, please go ahead.
Yes. So go ahead.
No, my next question would obviously then be that are these companies overvalued? I mean, if I look at some of those companies, and for some reason, ever since we've seen that the markets recover and go up, people are looking for stocks which they just look at the multiples and see if the multiple is low, let's buy it. And they're buying it and they're all gone up 20, 30%. And to me, they look like they've become expensive suddenly.
I don't think that's the way you need to look at it. If a stock falls 95% from the top and goes up 30% from the bottom, it's quite meaningless to even look at that number.
No, but if I look at some of those real estate companies, for instance, some of them have managed to retire debt, have become, like DLF announced that it's even doing some bit of capital infusion there. But you know, the way in which the valuation was originally done was done on the basis of land bank. And in the heady days of 2007, analysts were looking for excuses to give value to every company. You would say the sum of parts, demerger, this, that, land bank, and you could find anything. That valuation, of course, is completely gone. But I'm saying, is it entirely done? You think that all of it has been completely factored in by the markets in the last 5-6 years?
I don't think markets factor in 100% of what is expected.
All right.
Okay, a lot is also dependent upon how the company is really executing. So if you show financial discipline, if you've been able to manage your balance sheet well, market rewards you longer term. So I honestly wouldn't look at what's happened in the last 1 year to say that companies are overvalued or undervalued. And I just go back to the beginning of this conversation, wherein I say equity markets today are hitting all-time highs, not in India, but it's been across the world. So markets equity as an asset class has been quite resilient. And it could, one of the biggest reasons being identified is the surplus liquidity that's there in the system. Okay, liquidity does slosh around and finds its way into...
is it the new normal? Is that the new normal? Is PE expansion the new normal with the given liquidity? Is equities going to be the only asset which gives you returns in the, let's say, at least in the medium term?
Look, I'm an investor who looks at cash flows. Anything that drives cash flows, I'm willing to pay up a price, and I'm not willing to pay up a disproportionate amount of money for free cash flows. Okay, so if some part of the market doesn't make sense to me and those businesses are not solvent, I would step back and I would not even try to identify with what's happening out there. So give me a good business, and there are plenty of them who are running a business through efficient capital. The companies which are large in their sector, and if I find it,
to ask, does your compliance allow you to name stocks? Because I don't want to miss the chance of.
I mean, if you look at the parameters,
I don't want to miss the chance for our viewers to get stock ideas from you, if it's possible.
I mean, I don't think that helps in either the near term or the long term, because
it doesn't. It doesn't help an expert like you. But let me tell you, viewers who can't do the analysis of the kind that you do or have the experience, they will definitely gain if you can give them some stocks. And obviously, with the disclaimer that this is not some guaranteed growth, but your ideas, the ideas where the way in which you see things developing long term. Just give us some names and why you think they will do well.
I mean, I'll step away from the names right now, but I just say that any company that's handling financial risk or having too much of debt on their books, I'd completely avoid those companies in putting them into the portfolio. I think the strategy is very simple. Look for a business, look for a franchise that'll survive into the next decade. Look at a management that's got financial discipline. Okay, you'll have a portfolio which is extremely great over the next couple of years.
Number one, avoid companies which don't have financial discipline, probably don't have good interest coverage ratio, and probably have very high debt but don't really have a plan to work. Okay, that's the number one advice from Kenneth Andrade. Number two, what are you going to do in terms of the current economic scenario?
Well, I'm an equity investor, so I continue to look for opportunities that exist at every part of the market cycle, and usually opportunities come in when the environment and the news is extremely bad.
Yeah. So
okay, so we're just looking at
IT services, very bad news in the last 3-4 days. What would you do there?
Well, when you have large mature companies trading at these valuations, it definitely warrants to look at what's happening out there in the sector. And when you do get news which is a little negative or largely negative across the entire industry, you would also have valuations follow the same path. So you look to see where the bottom gets made in some of these larger names and align with them.
All right, I was reading up on an interview that you did recently, and you were saying that you see structural changes in consumption, and especially with wage growth. Now, if one looks at wage growth, I'm assuming you're also talking of, one is the pay commission, of course, the 7th pay commission. It's not turned out to be as much of a bonanza as people thought. I think even the arrears are not going to be paid this month. They'll come in August. Some of those allowances are going to be actually given over 4 quarters. There is therefore a limited impetus. Then there was an estimate that there will be a 10% growth at the beginning of the year, 10% growth in wages this year. Overall in the corporate sector, startups, etc. will give about 20%. And then we saw some of the big startup names actually saying that we can't hire. We'll take you in December. And that was a bit of a dampener, wasn't it?
When you're looking at one faction of the market, I mean, the other faction of the market is where a lot of structural changes have happened, and these are all policy initiatives that have taken place. It also accounts for 60% of the total population in India, and I think that will be the moving part in the next couple of years. Rural India, at least from the Government of India context, they want farm incomes to double by 2022. And it is more to do without increasing minimum support prices. Okay, and if you've been able to implement what they've started out to do with the farm insurance scheme, the crop insurance scheme, and implement it across the country, you effectively remove cyclicality from the monsoons. Okay, so once you stabilize cash flows on the ground, I think you got a huge momentum or you have huge confidence in consumers in that part of the country, and that accounts for a bulk of your population, and it's actually the bottom end of the population pyramid in India. So that gathers
consumption basket of that part. Mr. Andrade, if I look at the consumption basket of that part, whether it is final consumption or whether it is productive consumption in terms of tractors and things like that, what would you pick out as the things to watch out for?
I'd go straight for the productive part of that economy.
All right, which is essentially the agro, maybe tractors and things like that, insecticide, pesticides.
I mean, when industry gets cash flows, they invest in productivity. When cash flows come to any part of the industry, which here we're talking about the agrarian part of the world, my sense is that they first invest in higher productivity and higher incomes, and then they take it to discretionary consumption. So that's the path I will follow.
Okay, don't name names, but at least give us some subsectors, whether it's seeds, whether it is pesticides. What are you looking at? Tractors. Which is the space where you think there is decent valuation at the moment?
Actually, it cuts across the chain. You can look at financial services because they have a very large role to play in it. It cuts across agricultural inputs, so you can break it up into seeds, agrochemicals, as well as fertilizers. Then you can look at the mechanization part of it all, but that's going to be critical as it builds on wage inflation, because you have to mechanize your farm, you have to put significant amount of farm inputs or invest in farm inputs for higher productivity. So I think it's not a very small segment to look at it, and it is a multi-billion-dollar opportunity which is out there. It's almost 16% of India's GDP comes from agriculture. 60% of the population lives on cash flows from that 16% of cash flows.
If I look at the microfinance institutions with rural play, some of the housing, non-bank housing companies and stuff like that, are you happy with the valuations there?
I mean, what are valuations here? I mean, you're looking at 3 times price to book, and that might look expensive for a company which has just been in operation for the last 4, 5, maybe 6 years. If this company has been able to double its lending book, which most of these companies talk about, into the next 2 years, you probably need to recompute your book value as to where it will stand after 2 years. The second big element about these companies, and a lot of them have gotten licenses and will become small finance banks going into the next couple of next couple of years. And you not even put in, and you're not even looking at what the liability side could mean for some of these companies out there. So I think we need to look at each of these opportunities holistically before sitting on the judgment seat whether they're expensive or whether they're cheap. I'm sure some of these guys are extremely well managed, and some of them have processes, and some of them have the vision to build organizations out there. So I'd just go out there and make sure that I can pick a company that executes well, rather than worry about whether it is expensive and I will not make money near term. I just buy a good company which is there. So I think the focus necessarily needs to be identify a business that lasts into the next decade, someone who is very efficient in the use of capital. I think you will be okay. It doesn't matter which industry they come from.
Right. Urban demand, do you think that it's kind of saturated?
Using elements of, using some parts of the market which are doing well in urban demand also. So I don't think it's going to be impacted as dramatically as what the numbers suggest in the first quarter at least.
All right. One final question, Mr. Andrade, and then I know you've given us a lot of time, but it's news driven right now, and that is the telecom sector. We saw these price cuts yesterday, major price cuts from the existing players, Reliance Jio coming in probably by the end of the year. Is this a space that an investor should get in at all? I mean, it's a great thing to use the phone and run your computer, but should you put your money in there?
I'd wait and watch to see how it evolves itself. There's a lot of balance sheet that's been put behind these businesses just now. I wouldn't want to preempt it all right now. It's a fairly large industry that is sitting out there, and there are very large players with a very large balance sheet in that segment. So I'd rather wait and watch rather than preempt and try to put money to work in that industry.
All right. Kenneth Andrade, thank you so much for speaking to us and taking our time. It's been really great talking to you, and we've learned a lot today. Thanks a lot.
Thank you.
And you didn't take any names. I tried my best, but you didn't, so there's no disclosure to give either. Thank you so much.